Ed Harrison here for Real Vision. We are live for the Real Vision Daily Briefing. I'm with my partner in crime today, my editorial buddy, Jack Farley. Jack, welcome back.
Great to be here, Ed. Great to be here live. And by the way, I might add, live without net.
Exactly. And by the way, we're switching chairs because today I'm the host. Usually you're hosting me. I get to ask you all the pertinent questions. The first question out of my mouth is, what's going on in the markets today? How would you describe the markets? It seems like there's not a whole lot going on. What are you seeing?
Well, Ed, I'd say if the market were an ocean, I'd say that you've got some placid waters on the surface, but there could be a few sea monsters underneath. So as you sort of implied, with the equity market, not a lot of ton of action. The Dow up almost a point. NASDAQ up 0.37% and the S&P up 0.82%. So markets did advance higher, but the VIX remains at that about 20 level. But Ed, what I have my eye on is that earnings are still a thing, and almost 20 companies reported earnings today. And I noticed that one company was down 15%, Etsy. Another company, a lithium a miner and producer for electric vehicles, down 9%. That's Albemarle. So even though in the equity action, in the equity indexes, you're not seeing a lot of action, underneath there could be some chaos roiling underneath.
Yeah, and for me, if I had to describe it, I would say that people are looking for the next trade, meaning that a lot of the reopening trade has already been priced in. The reason I would say that is because when you look at the earnings that we did have that were blockbuster last week from the FANG-M, they were great earnings, but really nothing happened in terms of the stocks. It didn't really propel the market forward in a way, even though their earnings were far beyond expectations. So I think that the market's sort of in a wait-and-see mode until it sees what is next on the horizon. And Jack, I would also add that I'm looking at the 10-year, and it's at 156.8. It really is not moving a lot. The volatility you were talking about, the VIX, the volatility in the bond market is also relatively low, and I think that that's adding to this sort of wait-and-see mode that I'm seeing.
Ed, tell me, I want to get your take on the bond market. We have been stuck in a range, but some would say inputs into the bond market, such as the labor market, treasury issuance, as well as inflation break-evens, they have not been trapped in a range. We've seen a lot of action in the inputs, despite the fact that bonds have remained in that range. What are you seeing? I saw that there was some economic data from the labor market today. What did you make of that?
Well, even before we get to the labor market data, and I want to get to that because we had, labor market data yesterday, the private payrolls. Then we also had jobless claims, and then tomorrow we have the jobs numbers in the U.S. But I'm actually thinking about inflation, Jack. I'm thinking about, I saw two articles at Bloomberg talking about inflation from different points. So the one inflation that everyone's talking about is supply chain inflation. And this article is basically saying the inflation risk is intensifying because the supply shortages are actually multiplying as we're doing the reopening. So supply shortages are getting worse, and it's to the point almost where you're going to see prices rise. It's definitely going to happen. We're at that point now. The second article, which I thought was interesting, is it was titled "Just About Everything Costs More at an American Grocery Store." And they were going through, when people shop for food, that food stocks are going up. And I even saw something about chicken prices going up at KFC and other places because of supply chains. I don't know what it was, but it was also within the inflation basket. And so my thinking about that is it must be having an impact on expectations, inflation expectations, and therefore, eventually, we should be seeing this in the bond market. But the bond market's not going anywhere. Let me ask you, what are you seeing in terms of inflation expectations, other signs that we're not seeing on the surface when you talk about beneath the surface? Are there other things happening given this inflation story?
Well, Ed, there's so much there, and I want to get into the supply chains disruptions. But if I'm just looking at the chart, just looking at what market participants are pricing in, the answer is clear. People are pricing in more and more inflation. The US 10-year inflation break even, so market participants' expectations of what inflation is going to be over the next 10 years, has marched steadily higher, even though we have been and this kind of detente in the bond market over the past 2 years. 2 months. And as a result of that, because the real yield is the difference between the nominal yield and the inflation break even, US 10-year real yields have declined. Now, when we had that bond market rout and nominal yields surged, that was sort of a catalyst for a real weakness in gold that went down to as into the 1600s. However, today it broke past 1800 because as the U.S. 10-year real yield is declining, basically the value that you can get from bonds in real terms, inflation for adjusted, has declined, and as such, that's what we're seeing from gold. So that's what I have on my radar.
Very good. And, I know that you are looking even deeper because you told me just earlier about a conversation that you were having with someone who's deep into the weeds on these pictures of about expectations for how the Fed's going to act. Because, I mean, ultimately, bonds are really a composition of a bunch of short rates in the future amalgamated into one long rate. And the question is what is the Fed going to do in those short-term futures? Are they going to do what we think they're going to do now, or what they're telling us they're going to do? Or are market participants already starting to bet that the Fed is going to accelerate its timetable because of these inflationary underpinnings that we're talking about?
Yeah, so I spoke recently with Nancy Davis, who really has her finger on the pulse of interest rate volatility. She actually has the only ETF that currently owns interest rate volatility. And so her ETF is called iVol, and it owns TIPS as well as long options on basically swap rates or so-called swaptions. So it's very complicated. And I've been talking with her, and she's really opened my eyes into the deep, deep world that is interest rates, futures curve, swaptions, swap spreads, forward swap spreads. So I've spent this entire day really deep in that pool, and I'm glad to be back up so I can on the RVDB so I can get some air finally. But yeah, so Ed, we spoke on the RVDB earlier about how Fed fund futures has been steadily rising. As of January 1st, what market participants thought that the Fed funds rate would be was barely over 10 basis points, which is barely what it is literally today. Then on March 1st, when you had that bond rout, suddenly the Fed funds futures for 2025, say, was just under 30 basis points. Now that it's May 6th, we are at almost 70 basis points. In fact, over 70 basis points for September 2025. So yes, this is extremely far out, and it's not a super liquid market. But basically what Nancy Davis was telling me is that the investors are calling bullshit on the Fed. They think that they will raise rates. So you've seen not a ton of action in, let's say, the U.S. nominal 10-year, the U.S. nominal 30-year over the past 2 months. But there's the march higher in future expectations of the short end of the curve. That action continues to be very robust. And in fact, the 5-year forward rate for the U.S. dollar swap rate, swap futures curve, which is very complicated, it actually is in backwardation, meaning that in 5 years, in May 2026, the market estimates that you could get money cheaper, essentially, on the 30-year than the 10-year. Basically, and the reason being, Ed, is because they estimate that the Fed will continue to raise rates. So basically, I've been deep in that pool, and the message that I have coming back from that pool is in the deep, deep world of interest rate options and futures, they call bullshit on the Fed.
Very interesting. The last thing that you said, I found really interesting. Maybe you can explain it to me because I don't understand exactly. But when you mentioned the 10-year and the 30-year, immediately I started thinking about a yield curve, going negative, or not going negative, but a yield curve that is not upward sloping but downward sloping. So when you say the 30-year is lower than the 10-year, is that a downward sloping yield curve, inverted yield curve?
Short answer is yes, but I'm talking about a very specific curve that is the US dollar swap curve, where market participants exchange a floating rate for a fixed rate. So that's slightly different than the US Treasury curve that most people think of. So I don't want to necessarily say that people are pricing in a inverted yield curve, because when they say yield curve, they mean just the basic yield curve. Whereas Nancy likes to play a little bit above the rim, so I had to get my ladder. But yeah, that's pretty much it.
Right. I think it's very interesting. I would say that this is the big story as we await what happens with the reopening. So bringing it back to today, the question is what is the reopening going to look like? How accelerated is inflation going to be? Not just inflation, but I think more and more people are thinking about the Fed when they think about their dual mandate, less about inflation. They think that Jay Powell's less focused on inflation and more focused on employment. So even if the Fed, stays as a result of inflation, they could accelerate their timetable based upon the labor market. So let's talk a little bit about the labor market and what you're seeing there. So we had private payrolls on Wednesday, 742, I think was the number. It was a little bit light because 800,000 were expected in private payrolls. This is the ADP number. Then today, we had almost 500,000 jobless claims. That's actually the lowest since the pandemic, since March of 2020. And then tomorrow, we're getting a jobs report. What are you seeing there? What's your general commentary?
Well, Ed, you just relayed the information, but really I'm the one who wants to hear from you, because I've sort of been living in the matrix of interest rate futures. You've been in the real world with the real economic data. So yeah, I want to hear two things. I want to hear your take on commodity inflation, which maybe we'll get to later. But yeah, with regards to the labor market, that data that you just said, Ed, what's your take on that? That's what I want to hear.
Well, I was before we got on, Jack, I was looking at non-farm payrolls. They were 916 in the previous month, and the expectation that I saw was 978. So we're expecting almost 1 million jobs, more jobs than we had last time. I think that there are two things to think about. One is, what do the adjustments look like? Usually when there are adjustments to prior months, and those are upward adjustments, so 916, say, goes to 950 or 960, that would suggest that, the labor market's doing even better than you thought. But if we see a underperformance vis-a-vis forecast of 978, or we see some downward revisions to 918, it might give people some pause about, the robustness of the cycle. So that's the first thing that I'm thinking about. And then the second thing I'm thinking about is that as we take this pause in terms of looking for, what the next impetus for the market is, really, if you believe that the Fed is much more geared toward employment, these are the numbers then to watch, not just for this month, but for the next few months. If we're printing 1 million jobs as the print every month for April, May, June, I think by the time you get to the middle of the summer, the end of the summer, the Fed is going to change its tune. And so that's what we should be looking for.
Yeah, and in fact, I heard a commenter on another network who I have respect for say exactly that the reason that the stock market is not being zealous and having the ebullience we've seen on the incredibly good earnings is because they are pricing in exactly that. But Ed, take me into the weeds. Like, let's zoom in a little bit, because I think based on talking with you earlier that the demand for workers in the economy is red hot, but the demand for work is perhaps slightly less so. Can you tell me about that?
Yeah, that you make an interesting point. Actually, I read an article recently that was very, very interesting. It was in the Pittsburgh Business Times. And the way that it talked about it, it said that as March was winding down, Clavon's ice cream parlor in the Strip District, they didn't have enough workers to be able to deal with the upcoming spring and summer rush for ice cream. And so then on the 30th of March, they decided, you know what, we're going to double the wage that we're going to offer for our lowest level employees, the scoopers, from $7.25 an hour, which is the minimum wage, to $15 an hour. And then apparently this got a lot of coverage in the media. Workers were captivated by it. They just got tons of resumes as a result of that. Then there was another part within that article that talked about a woman who works at a sports bar. And in this sports bar, they guarantee that you will make $20 an hour, even if the tips don't bring you up to the $20 an hour. So there's a $2.83 minimum wage for tipped employees, and then you get your tips on top of that. That should take you up to 20. But if you don't get to that level, they will make up the difference. And this woman, her thing was that, I feel way more motivated. I don't dread going into work the way I do at other places. And obviously, she said other employees feel the same way. So, to me, this is a really complex problem, because on the one hand, you have schools that are still closed. You have people who have childcare issues as a result of that. You also have the fact that you're getting unemployment benefits that in 43% of the cases, my understanding is, actually are greater than what you would get if you went to work. And then you also have people who are still very afraid of the virus. And when you have the ability to get these enhanced unemployment benefits, and you have these childcare problems, all of that combines with this low wage problem to say, maybe we are not going to re-enter the workforce. Is that a good thing or is that a bad thing? I don't know. But I think that it's a complicated issue, and we won't get a good feel for it for the next several months, what's actually going on underneath. But my hope and my belief is that the labor force participation rate will increase over time. And right now, the only reason that the economy is holding together as well as it is, given some of these underlying trends, is because of government transfers. And that's the thing that will hold us through until the labor participation rate starts to increase.
Well, Ed, thanks for that. You gave a very objective description of what's going on in the labor market. Some people I've seen on Twitter, though, have almost talked about it very negatively, with some revulsion perhaps, about, oh my God, we're going to have to double wages. I can't believe this. People are having to pay $200 just to get people to show up to an interview. Just to play devil's advocate, Ed, what is so bad about putting money in the pockets of people who need it most? For a very long time, that has been the exact problem: wealth inequality, and then people at the very bottom of the income spectrum they have the most propensity to spend it. They actually can't get money, whereas people at the very tippy top, who how many yachts can you buy? Is this go saying, and that has really been a cause for secular deflation over the past 20 years. What's so bad about that finally reversing?
Well, I think there's not a whole lot that's bad per se. But let me give you an example, just like a numerical example. So let's say that the minimum wage is $7.25. Let's say you made $10 an hour, as did your spouse. You both work 2,000 hours a year. That's 50 weeks times 40 hours a week, and together combined, you'd be only making $40,000. So you're getting more than a third more than the minimum wage, and you're still making, in a two-income family, $40,000 a year. So that gives you a sense of how low the minimum wage is. Now, that might work in some low cost of living places, but in San Francisco, where the median two-bedroom apartment is over $3,000, in Massachusetts, where the median is almost $2,000, that's not going to work. So I think that it's a problem. It's a problem that people are living on the edge, and we have to figure out a way to fix that.
Yeah, and I guess the worry is that you're going to have a wage price spiral of inflation that's going to sort of take us back to the 1970s when things really got out of control. And if that happens, I've got my fat tie ready, so we can be on and be news anchors in 1970s style. But Ed, I want to take us back about 6 months, where we first began to see that commodity inflation. The price of oil was going up, the price of timber was going up. People were talking it was insane back then. Little did they know. You, however, didn't really think that we'd see true inflation. That it would be somewhat muted because of this wage price dynamic. With so many people unemployed, you continued, basically, it would be hard for there to be inflation. You pretty much been proven right. Inflation has gone up, but it's been muted. I mean, the last print was 2.6 compared to 2.5 expected. So when are we going to see, Ed, that the real fireworks in the CPI?
But even if we saw real fireworks, let's say 3%, 4%, it could be just a step change. It doesn't mean that it's going to stay with us. I mean, the way that I'm looking at it, going back to my previous answer to what we were talking about, the government transfers pushing us through. If you combine what I was saying there with what you were saying about the marginal propensity to spend, as soon as the government takes its foot off the accelerator, suddenly you don't have an impetus to accelerate the economy. Suddenly there's a big hole in the economy, and it's not being filled by people actually spending tons of money, just as you were saying. And so those people who are making $7.25, $10 an hour, if they were making $15 an hour, maybe you would see that accelerator, but they're not. And so I think that the new normal, just from their perspective, is going to be very similar to the old normal, and that's very much more secular stagnation oriented. And I think that this whole wage price spiral thing is a little bit overplayed. I think it's going to be a muted step change up as a result of supply disruptions, and then after about a year, it will dissipate. Let me ask you some questions here, Jack, because we have some. I think we might even have a lumber question here that was in the mix. Let me see if I can find. Yes, here we go. Since you mentioned lumber, this is from Tom. He asks, lumber prices look unstoppable. How far does it have to go to affect the housing market? Do you have a view on that, Jack?
Well, Ed, I know a lot more about real estate investment trusts than I do about how to build a house, how to buy a house, what house even costs. I'm in New York City living in an apartment, so I really don't know a lot about that. But what do you think about that?
I don't have a lot to say about how lumber affects the housing price, because I think ultimately the biggest component of house price inflation has to do with dynamics that aren't about the building. Those prices get eaten, and maybe they can get passed through, but there are other dynamics that are at play, and those are probably more fundamental. So I just think that it adds to an overheated market, but it's not a longer-term driver per se of what's going to cause house price inflation.
Yeah, and talk about an overheated market. The Fed still continues to pump a minimum of $40 billion worth of dollars into the mortgage-backed security market, of course, the mortgage market. So it's really pouring kerosene on a market that is one of the most overheated sector in the American economy. So, are they going to taper by the end of the year? Who knows?
Well, interestingly, Jack, I saw today that mortgage rates were at their lowest in 3 months. That I think it was the Freddie Mac 30-year fixed hit a 3-month low. And so, it's not just what people can afford to buy, but it's also the refinancing. So, this is potentially this is where the Fed is. This is the secret sauce that the Fed is using beyond just fiscal transfers in order to juice the economy. Because to the degree that people can refinance, that gives them the wealth effect that, they could potentially take money out, redo their home, et cetera. So the housing cycle gives legs to the market, to the economy. So I think that this is something that potentially takes us a bit beyond just the fiscal side and brings in what the Fed can really do with their low interest rates.
Yeah, and if you own a mortgage, or if you have a mortgage, I should say, you're actually long optionality because you can refinance if rates go down. And if you own a mortgage, meaning that someone who has a mortgage owes money to you, if you're a bank, you're short optionality. So there are complicated dynamics there, which I am not an expert on at all. But Ed, I want to ask you a question from Tom, going back to the labor market. Do you think that the labor shortage is transitory or a longer term issue? Because Ed, I want to hold your feet to the fire a little bit. Let's say this ice cream scooper who's got $7.25, now their salary is more than doubled to $15 an hour. As our good friend Darius Dale says, no one ever takes a pay cut. So if it's at $15 now, are they going to take a $7.25 in a year from now just because the Fed stopped tapering?
Well, I think it was Walmart moved to $15 an hour a while ago. I think their average salary now at Walmart is 15. I think the starting salary at Costco is something like $16 an hour. But that's at the margin. The wide swath of places, they're not making those changes. So I don't see where you're going to get this sort of wage thing that's going more and more. What I think is going to happen is that all of these extra benefits from the federal government are going to expire. At some point in time, they're not going to be renewed, let's say in 2022. And when that happens, people will face a choice. Do they take the $7.25 job, the $10 job, or are they penniless? And so you will see more people enter the workforce at that point in time. Moreover, childcare issues will have been dealt with because, in all likelihood, schools will be open. And so we're going to see labor force participation go up, which is a good thing, but it also means that there's less reason to think that we're going to have upward pressure on wages. So I'm skeptical about this whole concept that we have a wage price spiral. I'm still in the camp that says it's transitory. So I agree with the Fed that inflation is transitory as a result. And I think the deflationary trends are probably still intact. And I think where I'd go in throwing a question back to you on that, because one of the first questions that we had here as we were talking, Jack, was about that. Doug was asking, he was saying demographics, technology, et cetera, pushing for deflation. What should I look at for canary in the coal mine to the realization that these are facts? It seems that inflation is short-term only. I mean, that's what I'm saying. What are you looking at? I mean, what would change your mind as to what I just told you?
Well, I think conventional wisdom would say that the very somewhat lavish benefit, not lavish, but higher than very higher than normal, elevated levels of fiscal benefits for unemployed people and stimulus checks, that has to end, because sooner rather than later, the government has to restore the you can't have a budget deficit. We've got to restore the balance sheet of the American people. What about if not? What about if these stay for 2 years? Because I believe congressional approval, which has long been extremely low, is actually relatively high now, because people are saying, hey, the government is doing its job. It is taking care of people. A lot more people think that than, oh my gosh, did you see the latest chart for the budget deficit? I am pissed off. I want to email my congressman. I also.
So what you're saying is like, I think you saw the interview I did with Dario Perkins, right?
Yeah.
He's a guy from TS Lombard. And basically his argument was that in today's world, post-Great Financial Crisis, MMT has come to the fore, and it's now the software for a total rethink of the way that we think of fiscal deficits. And I mean, what you were saying was basically what he was saying is that perhaps, people think about deficits so differently that you will see some permanent level of fiscal transfers to people that were unthinkable, say, a decade ago.
Yes, I think so. And I think that the reason, let's say, 50 years ago that there was a decrease or there was a cutting of government spending, a cutting of these social programs, was because inflation was this bugaboo runaway nightmare that was ruining everyone's lives. Well, it's hard to find someone who doesn't have gray hair who even knows what you're talking about. Inflation really has been for 30 years has been muted, not elevated, and over the past decade, it's been too low. Central bankers have been firing billions of dollars into the economy every single day, trying to get just to 2%, and they haven't even managed to do that. So I think that fears over inflation, when people in the markets that we talk about inflation, they're thinking about, oh, what's the trade? Should I buy gold? Should I buy oil? Should I buy XLE? Whatever. People like Jared Dillon, who I spoke with yesterday. I think when government policymakers, they're thinking about inflation as, oh my God, this is something that we have to avoid. But if it hasn't been present for so long, are people really going to be afraid of it if it's only something that they heard their parents talk about?
Well, let's go a little bit further with that whole thinking that we had with Dario Perkins. So he was saying to me, look, I agree with you. Basically, he was saying about the secular deflationary tendencies, disinflationary tendencies, and I don't see labor with any sort of ability to counteract against capital. Meaning, I don't see any bargaining power that's increasing there. So after we get this spate of stimulus, we're going to be back to the old normal. It's only once we do sort of MMT-like policies over a longer period of time, where over time labor becomes more powerful and you close the output gap, only then will you need to worry about inflation. That's when gold comes into play. That's what I heard him say, that it's going to be muted for now, but later, that's when you have to worry. The outcome, the end game is inflation, not the near-term game. What do you think of that thesis?
I think it's really compelling. And I watched your interview with Dario, and I recommend that people at home watch it too, because there's just so much there. And I want to turn us back to the bond market. So if inflation is going to rear its ugly head, then bonds must be grotesquely overvalued, right? No? So let's take one of these many questions. David C. says, why is it that the 10-year is going sideways with everything that is going on with inflation and costs?
Yeah, and that's this is a question I'm going to kick back to you, Jack, because the 10 years going sideways, but you just told me not only are inflation expectations going up, but in the swaptions market, and you have this backwardation and a bunch of other things that are happening that suggest that people are actually making real bets for the Fed raising rates more quickly. Why is it that that's disconnected from what we see in the actual Treasury market? I don't have the answer to that. Maybe your interview with Nancy elicited some response.
Well, I know what our colleague Weston Nakamura would say, and it would be in line with something that David Tepper, hedge fund manager, threw out a few months ago, which is that the Japanese are going to start buying treasuries. In other words, foreign demand is going to start playing a part, and there is going to be a demand for a pristine collateral that is essentially a positive carry put. And it will generate yield for you, admittedly very close to zero, but it will be something safe that if stock markets tank, if risk assets tank, it's going to be there for a rainy day. What else are you going to own? Are you going to own a European bond that has a negative yield? Are you going to own a Turkish bond where it's just crazy and a central banker gets fired every single day? So I don't really know. I think that currently the dollar is the global reserve asset of the world, and if you can own dollars and get yield on it with essentially no credit rate risk, that's something that people will still want to do. So I don't necessarily buy that, and I don't necessarily that's going to be something going forward. Someone else in the comment talked about how TLT is 25% sold short, but I think that there are a lot of things at play. What do you think, Ed?
No, I think that's as good an answer as I could have given. So hats off to you on that.
I don't believe
that. Since we're getting long in the tooth, I'm looking at the time. There are three comments that came up after David C's comments. let's go through them, and we'll wrap after that. But I want to ask you, because I have an answer to this first question, but I want to ask you the same question. This is from Deanna, who asks, are there metrics that you're watching closely now as compared to, say, a month ago? And I think the answer is, I don't know if you could say I'm looking at something more closely, Jack, or not. Jobless claims. I'm looking at the employment numbers. So when I talked earlier about the employment numbers, my framework is that I believe that the Fed is actually more concerned about employment than they are about inflation. So when they talk about their dual mandate, implicitly what they are doing is saying we care more about one mandate than the other mandate. We're fine with letting this mandate do whatever it does, because not only are we concerned about this mandate, but there's also social outcomes that we care about, which are the kinds of things that we were just talking about with average wage earners. So I'm looking at those numbers. If those numbers come in hot, i.e. big numbers on the one side for jobs and low numbers for jobless claims, then I think the Fed could move up its timetable. So those are the numbers I'm watching. How about you?
Well, the answer you just gave is so much more cohesive and comprehensive that I'm going to give, but I'll list a few things. Interest rates, obviously, interest rate differentials, the spread between the U.S. 10-year and the German 10-year, the Italian 10-year, that has edged up higher, which has kind of been a catalyst for money flooding into the dollar, and that's why people have been buying bonds, which pushes yields down. Commodities, I mean, lumber's at an all-time high. Lean hogs is pretty close to an all-time high. Copper is over 10,000, whatever the denomination is. So commodity inflation is something I have my eye on. I would add the VIX as a category, so equity volatility. I sort of like to take a look at like individual implied volatility for individual stocks, for stuff like XLE, for maybe looking at selling puts or buying calls or doing some sort of stuff there that I'm. And then also I'd say, lastly, this new vista, this new world that Nancy Davis has introduced me to of interest rate futures and interest rate swaptions, the spread between future forwards and all this sort of stuff. And that's sort of, now I'm one day old in sort of knowing the lingo and stuff, but I definitely will have my eye on that going forward.
Sounds good. Sounds good. And now here's the next question from Sarah. You already addressed this, but maybe you can say it again, Jack. Gold and silver taking flight. Please address.
Well, they're two precious metals. Gold is generally thought of as a safe haven that trades inversely with real yields, which real yields is the difference between the nominal and inflation break-even. So as inflation break-evens, market expectations for inflation, continue to go higher, that would be a catalyst for gold to go up. The only question is, are nominals going to go with them? Silver is kind of like that, and silver's not the fish nor fowl. It's like half like that, and then half like people use it for actual real purposes in the real world. So I don't really know. What do you think about that?
Yeah, I think that because it's an industrial metal, it trades differently. But people look at the gold-silver ratio. I don't know what's happening there, so I'm not watching that as closely. So I can't give you a response. But it makes a lot of sense that when real yields decline, then people don't like that, and so they look for gold becomes more interesting as a result of that.
Yeah.
So final question for us. This is an interesting question. I like it. Doug F. He quotes a Bloomberg headline: "The White House backs nuclear subsidies that split climate advocates." And his question is what it will do for uranium prices. Let me give you my answer, Jack, and then yours, because I don't know what it's going to do, except, it would suggest it means that prices are going to go up. But let me just filibuster this whole question with the concept that maybe Biden thinks that nuclear is actually a solution as opposed to a problem. A lot of people, when they look at clean energy, they always exclude nuclear. They think of nuclear as dirty. But nuclear could be one of the solutions that's on the table in the future. I'd like to see a lot more commentary on Real Vision about how nuclear fits into the future, what that means for the uranium market, and also the environmental impacts of nuclear. Just without knowing more, I would bet that nuclear will be a big part of the solution in green, so-called green energy.
I think that that's a good point. I will say, Ed, that Lynn Alden did an interview with a hedge fund manager named Marcelo Lopez, who exclusively invests in uranium mines. And he recently, I actually am speaking with him later tonight. He's in Australia, so it'll be Friday for him. He had a good quarter. That's my belief. And if you look at something like CCJ or uranium ETFs, that trade has definitely worked out. Ed, my final question for you comes not from the audience, but from me, which is, tell us about this exponential age. We've heard Raul talk about it, but I want to hear, you had an interview with Raul that's going to air on Monday to sort of start us all off. What did you learn from that interview? What do you think about the exponential age? What does that mean to you?
Yeah, I think it's fascinating. There's so many different threads. I couldn't do it justice in the amount of time that I have. I'll try to put something together. The thing that Raul said that was the biggest takeaway for me was the nexus of exponential activity. So, I mean, the way that I'm thinking about it, when you think about technology and you think about things being exponential, you think about individual technological innovations as happening in a vacuum. Let's say, Moore's law, where computing power every 18 to 24 months, it doubles for the same price. That's something that happens, and that's in its world. But when you combine that technological innovation with AI, and then you combine it with the internet and a bunch of other things coming together, it creates this super connectivity that causes a monster exponential age, which I think saw, and this is the aha moment for me in the mRNA vaccines for the pandemic. Raul talked about that specifically, about how people didn't understand how much the exponential age was going to cause us to be able to get these vaccines as quickly as we did get them. That's a perfect example in a very positive way about the exponential age working for the greater good of society. So I still have a lot of thoughts, but I mean, that's the thing that stands out the most, that these exponential increases in technology all are coming together, hopefully in a positive way, but certainly in a way that creates a massive disruption to existing processes.
Absolutely. And I think that's what Raul calls a mega trend. In 10 years, do you think there are going to be more electric vehicles on the road or fewer? And how you express that trade is your business, and the people of the audience's business. They may want to buy Tesla, perhaps. That's been a good trade. They may want to buy Volkswagen. I know we're speaking to someone very high up at the research team from Volkswagen, so I'm excited to see that. Some people may want to buy lithium mines, because that's a key input into electric batteries, lithium batteries. Some people might want to buy rare earths, key input into the motors for electric vehicles. But and one thing that a lot of people seem to think is a megatrend, and it is crypto assets, that technology. And some may say a poster child for it, at least a month ago, was Coinbase, which had this direct listing. What if I were to tell you, Ed, that Dogecoin's market cap now exceeds that of Coinbase? Is Dogecoin a megatrend, Ed?
Yeah, what I'm going to say is I'm in timeout on this conversation, because Jack, that in the comments you added that question specifically because that it's going to trigger people in the comments that we're talking about Dogecoin all the time. So I'm just going to give a good laugh to that. I'm going to sign us off today. It's been a pleasure, as it always has been. And just know, before we sign off, everyone, Jack and I, we talk about Dogecoin all the time, but he's doing this on purpose. Trust me. Thank you very much, Jack. It's been a pleasure, and I'll see you again next week.
Pleasure's all mine, Ed. Thanks so much. And so we got to do this again with Bennington. I'm sure he's got a lot of thoughts on Dogecoin.
Yes, definitely.